Hey, how are you? I'm Duncan McPherson and welcome back to my channel. Today is the first in a series of videos I am going to do on common US tax concepts and our Canadian equivalents. Some things up here are pretty similar, while others are wildly different, and some, well, they don't exist at all. So buckle up and get ready to learn how to speak Canadian, because that's what I'm going to walk you through today. I'll try to keep this fun, but fair warning, some of these differences are going to make you scratch your head. And for more tips on how you can better navigate the Canadian tax system as a US business, don't forget to hit that subscribe button and click on the notification bell. Or skip the hassle and contact me directly at MacTax.com for more personalized help. Okay, today's topic is Canadian equivalents. And speaking of which, today it is February 2025. And did you know it takes $1.50 Canadian to buy $1 right now? So if you're thinking about a vacation, head north. You'll get a lot more bang for your buck. Now let's get back to tax and let's start at the beginning. The CRA versus the IRS. In the US, you got the IRS, right? The Internal Revenue Service. Up here, we call it the CRA, the Canada Revenue Agency. Okay, let's even go to a basier topic. Let's talk about some forms. What you call a 1040, we call a T1. What you call an 1120, we call a T2. What you call a 1041, we call a T3. Still with me? What you call a Form 1065, we call it a Form T5013. Yeah, between you and me, I have no idea where the hell they came up with that number from. Presumably, all the numbers between 4 and 5012 were taken up. Who knows? Who cares? But I'm going to tell you more about forms in a future video. And now for something completely different. Here's the big one, the Canadian National Sales Tax, the GST, the Goods and Services Tax. But here's a twist for you. It's a VAT tax, not a traditional sales tax. So there's nothing close to what you've got in the USA. And as I have said many times before, if you are carrying on business up here, either as a corporation or an individual, you will be required to collect and remit the GST, even if you are not required to pay and file income tax. I have hammered this point home in previous videos. So if this is new to you, please go back and check those ones out, because there's a reason I keep bringing this shit up. Quickie note, the GST is also known as the HST, depending on which province you're selling into. And we use those terms interchangeably up here, so just be mindful of that, please. Now, time to intrigue you with a few oddball conceptual differences. Another recurring night terror up here is that Canada does not have any sort of incorporated partnerships, aka the LLC. If your LLC needs to file in Canada, it will file as a corporation, Form T2, not as a partnership. And if you've got a single member LLC, it is not disregarded up here. It too will file a T2. With your LLC, the CRA may ask for proof that your partners are all US residents, or even require a certification letter from the IRS in this regard. And know this, exclamation mark, a Canadian resident should never own a US LLC. Bang! This is because we do not recognize the K1 income, and that is because we do not recognize the flow-through nature of an LLC. Ergo, the distributions from an LLC are treated as dividends up here. Therefore, a Canadian earning income in an LLC, the income is taxed twice. Once as ordinary income in the USA, and again as dividend income in Canada, and Canada does not give a foreign tax credit for the taxes paid in the United States, which means bingo, double tax. And by the way, you can't check the box and make it a C Corp to get yourself out of this mess. As far as the Canada Revenue Agency is concerned, once an LLC, always an LLC. And you thought we Canadians were sweet. Quickie note, Canada does have a limited partnership regime, somewhat similar to yours in America. Okay, now on to corporations. The next troublesome difference is we do not file consolidated returns here in Canada. All your corporate entities must file on their own. So if you have one Canadian subsidiary with profits and another one with losses, your profit co pays tax and your loss co gets a loss carry forward. Okay? I know this looks ridiculous to you, my American friend, but that's just the way we do things up here in the Great White North. Sorry about that. Another quickie note for you. The IRS considers Canadian corporations to be per se corporations. So for US tax planning purposes, you cannot check the box and make a Canadian corporation a disregarded entity. As you are probably aware, Alberta and Nova Scotia ULCs are taxed as corporations in Canada. However, The IRS does not consider them to be per se corporations, and you may check the box and change the status of these entities for U.S. tax planning if you wish. But I'll tell you more about this later on in the series. The next difference you're very likely to encounter is our approach to depreciation. To begin, we don't even call it depreciation. We call it CCA, or capital cost allowance. And yes, we think that term is ridiculous up here too. And I still think it's ridiculous, and I've thought it ridiculous for the last 30 years of my career. Our depreciation rates differ substantially from yours. Almost everything up here is declining balance, no straight line. And here is the weird thing. Up here, depreciation is an optional deduction, not mandatory like it is for you in the US. Up here, you may deduct anything between zilch and whatever the max depreciation is in the year. We don't have a use it or lose it up here. Recapture is similar up here. It is taxed as ordinary income. However, in Canada, unlike for you in the United States, recapture is treated the same for almost all classes of assets. It is taxed to you as ordinary income at your marginal tax rate. There is no IRC 1250, 1252, or 1253 recapture up here. Of course, with talking recapture, I now have to talk about capital gains. Your capital gains in Canada are treated the same across the board. It's proceeds less original cost gives you your capital gain. We do not have multiple classes of capital gains up here the way you do down there. But we do have a very funny rule up here. Unlike the United States, we only tax 50% of the capital gain. So in Canada, if your capital gain is $100,000, you're only taxed on $50,000 of that gain at your marginal tax rate. This is the same for corporations, trusts, and individuals. Quickie note for you, there is pending legislation up here that would increase the inclusion rate to 66% from 50%. So in the above example, your taxable capital gain would be $66,000, not $50,000. But currently, it is uncertain if this is going to become law. So maybe we can just shelve that quickie note for now. Fun fact though, CRA is currently assessing these certain circumstances as though the 66% were law. If the bill never becomes law, CRA will have to refund all of your taxes that they overcollected. Oh well, not our problem. Of course, no gains discussion is complete without discussing IRC 1031 exchanges. We do have something similar to the 1031 exchange up here. It's known as a Section 44 rollover or a like-kind exchange. But our 1031 only applies to business assets that earn business income, not your property income, aka rental assets. So, in Canada, if you're a manufacturer and you need new equipment or you need a new building, you may replace them at no gain. But if you're selling an apartment building, don't even think about it. Sorry, Donald. The laws up here are woefully complicated in this regard. So don't try this on your own. Call me if you need help here. I know the talk of capital gains leads us into the discussion of principal residences. And don't worry, that is coming up in a video that is more focused on individuals. All right, my friends, that's it for today. Future videos in this series will be more and more technical as I move forward. In other words, they'll probably bore you to tears if they don't apply to you directly. But as always, it will save you a world of hurt to know this stuff, I promise you. And if you're dealing with any of these issues or any other Canadian tax quagmire, call me at MacTax.com and let's make sure that your quagmire doesn't become a nightmare. And as always, don't forget to subscribe for more tax saving tips. Until next time, stay sharp, stay compliant, and stay out of tax trouble. I'll see you in the next video.